Silver EGS deficit story just turned into a funding and inventory problem, and the paper market can pretend it NAS academic anymore. There's a force trying to wave this off as just hype, just another shiny object spike, just retail emotion chasing a headline. But the signal isn't in the headline. It's in the plumbing. It's in the spread. It's in the cost of getting metal right now versus later. And before we're done, you'll know exactly what level matters, what metric to watch next week, and what has to break for this whole setup to fizzle. Because the move you're seeing is not primarily an opinion. It's math, inventory categories, and participants being forced to do things they don't want to do. And that's where the real pressure starts. Price looks like a meme until you zoom in on what's happening underneath the screen. In the last stretch, silver hasn't just drifted higher, it's been violent. It's been the kind of action where you can see it trade in a broad range, rip higher, slam lower, and then snap back again, all while people on the outside argue about narratives. Some of that range has been stunningly wide, and if you've been watching it day by day, you already know the emotional trap. You feel smart at the highs, you feel stupid on the dip, and the market uses that swing to shake people out. But that's not the part that matters. The part that matters is why the swings are happening now, why the deficit word suddenly hits harder than it did last year, and why the most underappreciated detail is not how much silver exists on Earth, but how much silver is actually lendable, deliverable, and mobile when the market demands it on a clock. Because if this one detail tightens, the math changes. Let S get one thing straight before we go deeper. This is not a promise of easy upside. This is the opposite. This is a warning that silver can whip around violently even if the core thesis is right. Trend signal and noise are not the same thing. A trend can be intact, while noise takes your confidence and wrings it like a towel. That's why a serious silver raid isn't, I feel bullish. It's what forces participants to buy, what forces them to sell, and what data would tell me the stress is easing. And the reason this matters right now, this week, is because silver doesn't move like a polite asset. It moves like a market where the physical world and the paper world are constantly negotiating who's in charge. And when that negotiation gets tense, price discovery doesn't get gentle. It gets sharp. It gets punitive. It gets fast. And that's exactly how people lose the plot. They trade their time horizon for adrenaline. They trade structure for emotion, and they get harvested. But here's the twist. That same volatility is often the footprint of a market under stress. It's not always random. It's often the symptom. And the next detail is what flips the whole setup. Deficits don't matter until they do. That sounds like a contradiction, but it's not. A structural deficit can exist for years, and price can still chop, stall, or even fall because the market has buffers. Inventories, financing, substitution, recycling, above-ground stocks that can be coaxed out at the right price, and participants who can roll paper positions forward and keep the whole machine running. A deficit is a slow burn. It's a pressure gradient. It's not an instant explosion. Until a trigger shows up, calendar stress, delivery window stress, or a sudden change in the willingness or ability to lend metal, then the same deficit that sounded like a boring statistic becomes a scramble. It becomes a bid for immediacy. It becomes a premium for now. And that's when spreads start talking louder than spot price. And that's when the mainstream, still staring at the headline, misses the real story. Here's the hidden detail, and it is simple enough to say in one breath, the market isn't T-short silver, it's short lendable silver. Read that again in your head. The market can have a lot of silver or somewhere and still panic if the right bars aren't a T available to borrow, to deliver, or to move through the pipes at the moment of need. Silver is not just a number on a screen. It's bar sizes, assay, location, title, and whether the metal is already spoken for. Some metal is sitting in vaults as long-term holdings. Some is tied up to industrial users. Some is owned by entities that do not lend, period. Some is in forms or locations that don't satisfy a particular delivery mechanism without time and cost. That's why you can see giant vault totals and still see stress in the market structure. This is the exact point where people get fooled by big numbers. But there's plenty in vaults. Sure, and there are plenty of houses in a city. And that doesn't mean there is a house available to rent this week at a reasonable rate in the neighborhood you need. Availability is not totals. Liquidity is not existence. And when the market suddenly needs the right metal right now, the price of immediacy is what moves first. The next detail is what flips the whole setup. That's where term structure and lease rates come in, and you don't need a PhD to understand them. Think of the futures curve like a timeline of promises. A near-month contract is a promise to deliver sooner. A later contract is a promise to deliver later. In a calm market with plenty of supply and easy financing, later delivery often trades at a premium because money has a cost and storage has a cost. That's the normal shape. But when the front of the curve starts trading rich, when near-term metal is priced above later metal, you're seeing the market pay up for immediacy. You're seeing backwardation. And backwardation in a metal market is a flare. It's the market saying, I value now more than later. That can happen for different reasons, and you always need to ask what's driving it. Is it a temporary dislocation? Is it a financing squeeze? Is it location-specific tightness? Is it delivery window stress? Is it a surge of industrial demand? Is it a short covering scramble? Is it an arbitrage bottleneck? But no matter the mix, the message is the same. Someone is bidding for prompt metal. Someone wants it now. Someone is willing to pay more now to avoid the risk of not having it. And that's where the real pressure starts. Lease rates are the other piece of the same picture. When you lease metal, you're essentially borrowing it for a period. If the cost to borrow rises, it tells you the market values possession. It tells you that lenders are more cautious, or demand to borrow has surged, or both. Again, it's not a conspiracy, it's incentives. In a tight market, a holder has optionality. They can lend and earn, or they can not lend and keep the asset. If they sense the probability of needing that metal, or they sense a risk of disruption, they demand a higher price to part with it even temporarily. That's a normal economic response. And when enough holders do it at once, paper positions that depend on easy borrowing suddenly feel the squeeze. But that's not the part that matters. The part that matters is what this forces participants to do. In paper markets, there are participants who are structurally short because they facilitate, hedge, or intermediate. They're not villains, they're market makers, merchants, refiners, hedgers. They can be short futures against long physical, or short options against risk books, or short as part of inventory management. Under normal conditions, that's fine. Under stressed conditions, the financing leg matters. The availability leg matters. The calendar matters. Suddenly rolling becomes expensive. Suddenly being short near term becomes dangerous because the cost of carry is not behaving, and the risk of being asked to deliver is not theoretical. So what do? They reduce exposure. They buy back shorts. They try to source physical. They shift hedges out the curve. They pay up in spreads. They bid for what's scarce. And if liquidity is thin while they do it, price jumps. Not because the world ended, because the math forced their hand. Because if this one level breaks, the math changes. Now let's talk about the deficit itself, because this is where people either get serious or stay in meme land. The silver market has been dealing with a multi-year pattern where demand has been running ahead of supply by a meaningful amount, especially as industrial demand has grown. Some industry surveys have highlighted big deficits in record or near record industrial demand in recent years. The exact number can change depending on methodology and year, but the direction has been persistent. Industrial pull has gotten heavier, and the ability of supply to respond quickly has been limited, and that's the point. Silver supply is sticky. Most silver is not mined because a company woke up and said, let's mine silver. A lot of it is produced as a byproduct of mining other metals like copper, lead, and zinc. That means higher silver prices don't instantly create a new wave of silver supply. If the primary metal economics aren't there, the mine doesn't expand just because silver is hotter. Even where there are primary silver projects, the lead times are brutal. Permitting capex, development, refining capacity, workforce, these are multi-year, not multi-week realities. So when demand accelerates or inventories tighten, supply doesn't snap back like a rubber band. It lags. That lag is where deficits bite. And that's where the real pressure starts. On demand, the biggest misunderstanding is thinking silver is primarily a sentiment metal. Yes, it has a monetary crowd. Yes, it trades with risk appetite sometimes. Yes, it can move with the dollar and rates. But the industrial side is not optional anymore. Silver is a critical input in electronics, electrical applications, and certain manufacturing processes. It's used because it has properties that are hard to replace at scale without trade-offs. When industrial demand surges, it's not just because someone feels optimistic. It's because production schedules exist, procurement contracts exist, and supply chains can't just stop because spot price is uncomfortable. They can thrift a bit, they can substitute in some applications, they can optimize, but those are not infinite levers and they don't happen overnight. Meanwhile, new demand drivers can show up in waves. Think solar build-outs, electrification, data infrastructure, and industrial investment cycles. Even if one segment cools, another can pick up. So when you hear deficit, don't picture a single monolithic number. Picture a market where one side can be persistent and sticky, and the other side is constrained and slow to respond. Then add financing, inventories, and delivery mechanics. Then you start seeing why the move can get nasty. But that's not the part that matters. The part that matters is whether the deficit is translating into stress signals right now. And we already named the stress signals: the curve, the borrowing cost, the premium for prompt availability, and the behavior of inventories that are actually deliverable. This is where vault reality comes in. People love to cite big vault totals as a mic drop. There are massive amounts of silver in vaults, so no shortage, and the mic drops on their own foot. Vault totals are not the same as free float. Some vaulted silver is held by long-term owners who do not lend. Some is held against financial products that have their own rules. Some is in a location or bar form that doesn't help a specific delivery mechanism without conversion, time, and cost. Some is eligible, but not registered, in the language of certain futures warehouses, meaning it exists in the system, but it is not sitting there tagged and ready for delivery against a contract unless an owner chooses to make it so. That distinction matters because futures markets are not philosophy, they're plumbing. Deliverability is a category, not a vibe, and categories drive behavior. If you have a pile of metal that is there, but it's not for sale or for delivery, it's like having water behind a dam in a drought while your town pipes run dry. Existence is not access. Access is what clears markets. And that's why the hidden detail, lendable, deliverable, mobile metal, reframes the story. The next detail is what flips the whole setup. Now layer in geography, because silver is not one single pool. It's multiple hubs, different vault systems, different delivery points, different standards, different logistics. Arbitrage is the force that tries to unify those pools. When one region's prompt metal becomes more valuable than another's, metal moves. Traders and merchants will buy where it's cheaper and sell where it's dearer, capturing the spread. That arbitrage is normally stabilizing, but it relies on the real world, shipping capacity, insurance, financing, and time. If something disrupts that pipeline, policy risk, tariff chatter, regulatory friction, or just a sudden surge in demand at one hub, the spread can widen and persist. And when it persists, it's telling you something. It's telling you that the paper price is not the whole truth. The truth is fragmented across locations and delivery mechanisms. That doesn't mean manipulation certainty. It means incentives and constraints. It means the supply chain just vetoed the neat textbook idea of one price. And once that happens, participants who assumed easy movement and easy borrowing have to adjust. They hedge differently, they bid differently, they cover differently. The market gets jumpy, liquidity thins, and price discovery gets loud. But that's not the part that matters. The part that matters is how institutional flows can collide with that tightness. Silver ETFs and ETPs, for example, can act like mechanical demand when inflows hit. They don't care about narratives in the way a human does. They follow flows. If money comes in, they acquire exposure that can translate into physical demand depending on the structure. When the market is loose, that's absorbed. When the market is tight, it's a catalyst, because physical sourcing becomes more sensitive. It becomes who has bars, who can deliver them, how fast, at what cost. And it doesn't take a massive inflow to matter if the marginal availability is what S-tight. This is why deficit plus flows plus a tight curve Staunsing is a different beast than deficit alone. A deficit is pressure. Flows are a shove. Tightness is friction. Put them together and you get sparks. And that's where the real pressure starts. Now let's talk about the part that makes people uncomfortable. Positioning. Because even a fundamentally tight market can punish you if positioning gets one-sided. When too many participants crowd into the same trade, the market doesn't reward correctness. It rewards survival. A crowded long can get cleaned out by a sharp drop that triggers stops and margin calls, even if the broader trend is bullish. A crowded short can get trapped by a squeeze that forces buying, even if the longer-term thesis for that short had merit. Silver is notorious for both. It's a leverage-sensitive market. It can be influenced by margin changes. It can be influenced by risk-off waves. It can be influenced by rapid adjustments in speculative positioning. And in that environment, the question isn't who's right. The question is who gets forced. Because forced flows move price the most. Forced selling on the way down. Forced buying on the way up. So what do you watch? You watch for signs that participants are being pressed. Sudden air pockets, huge intraday ranges, sharp reversals, spreads doing strange things, and the market snapping toward round number levels like it's magnetized. And that magnet behavior is where options reflexivity comes in. Here's the simplest version. When a lot of options exist around a big strike, think a major round number, dealers who are short those options often hedge dynamically. As price approaches that strike, the sensitivity of their hedge can increase. In certain conditions, especially when liquidity is thinner, their hedging can become a feedback loop. Price rises, they buy to hedge. Their buying pushes price up further, which requires more buying. That's a gamma effect. It's not mystical, it's mechanical. And it's one reason why silver can sometimes feel like it accelerates into round numbers. It's not because the number is sacred, it's because the positioning around that number creates reflexive flow. And if you're not watching for it, you'll misread the entire move. You'll call it irrational right up until it runs you over. But that's not the part that matters. The part that matters is what can interrupt that reflexivity. Because there are always counterpoints, and if you ignore them, you're not doing analysis, you're doing religion. The bearish case is not stupid, it's just incomplete unless it addresses the plumbing. A reasonable counterpoint says high prices can reduce demand, industrial users can thrift, some segments can substitute. Recycling can respond. Investor demand can cool if rates or the dollar turn against metals. And a big part of silver's behavior is macro: real rates, inflation expectations, currency stress, and risk appetite. If you get a sudden shift toward tighter financial conditions, silver can get hit even in a tight physical backdrop. Also, if deficits are expected to narrow in the coming year because supply edges up or demand growth slows, the market can front-run that. All of that is real. So how do you measure whether the bearish counterpoint is winning right now? You don't measure it by vibes. You measure it by, does backwardation ease? Do lease rates cool? Do location premiums compress? Do signs of deliverable tightness relax? Do flows reverse? Does positioning decrowd without price holding up? And do industrial symptoms, like procurement urgency, fade? If those stress signals calm while price stalls, it's telling you the squeeze pressure is easing. If those stress signals stay hot, even as price dips, it's telling you the dip might be a retest, not a reversal. And that's the real edge, distinguishing trend signal from noise. Because if this one level breaks, the math changes. Now, why now? Why this week? This month? Does the deficit narrative hit with more force? Because markets don't move in smooth curves. They move around calendars. There are windows where liquidity is thinner. There are windows where funds rebalance. There are windows where options expire. There are windows where futures roll pressure concentrates. There are policy weeks where macro sensitivity spikes. When you stack those windows on top of an already tight physical and financing backdrop, you get an environment where small shocks create big moves. A weekend gap risk, a thin liquidity pocket, a month-end positioning squeeze where funds adjust exposure, a policy meeting that whips the dollar and real rates. Any one of those can be manageable. Together, they can turn a stable trend into a violent sequence. And volatility isn't just a side effect. It's how the market tests conviction, flushes leverage, and transfers the position from weak hands to strong hands. That sounds dramatic, but it's just how leverage works. When margin pressure hits, participants who can't fund the trade sell. While when a short gets trapped, participants who can't withstand mark-to-market buy. Funding is the invisible hand, and silver is extremely sensitive to it. And that's where the real pressure starts. So let's lock this into a practical, finance-credible two-scenario lens, because pretending there's only one path is how people get wrecked. Scenario 1 is the controlled pullback and retest. In this path, silver cools off from an overextended push, volatility stays high, and price revisits a prior breakout zone or a major support area. The curve and tightness signals may ease a bit, but they do not fully normalize. You might see a dip that feels scary, but the market doesn't collapse. Then, if the thesis is intact, the retest holds, positioning cleans out, and the next leg can start from a more stable base. This scenario is psychologically hard because it makes you doubt yourself while doing something completely normal for a fast market. Scenario 2 is the continuation squeeze with gap risk. In this path, the tightness signals persist or worsen, flows remain supportive, and price pushes into major round numbers again with dealer hedging and short covering pressure feeding the move. This scenario is also psychologically hard because it can make you chase at the worst time, right into the moment where volatility is highest and the air is thinnest. Both scenarios can happen in the same month. That's not a contradiction. That's silver. The question is, what confirms each path? For a controlled retest, you want to see the market dip, but find real bids at known levels, and you want to see the stress signals not collapse. For a squeeze continuation, you want to see tightness stay firm while price holds above key breakout zones. And you want to see those round numbers behave like magnets with follow-through. But that's not the part that matters. The part that matters is the key levels and the invalidation, because analysis without invalidation is just storytelling. So here's how to think about levels without pretending we can predict every tick. There are psychological levels that matter, major round numbers that attract options positioning and attention. There are structural levels that matter, prior swing highs and lows where liquidity clustered, and there are kinds of behavior levels, places where the market S reaction tells you whether real money is stepping in or stepping away. If silver is holding above a prior breakout area after a pullback, that's supportive for the retest scenario. If it loses that area cleanly and tightness signals cool sharply, that weakens the thesis near term. If silver pushes through a major round number and holds above it into the close with spreads staying firm, that supports the squeeze scenario. If it spikes through a round number and instantly rejects with collapsing tightness signals, that's often the market telling you it used that level to distribute risk and reset positioning. And the keyword there is signals. Price alone can lie in the short run. Spreads and structure often whisper the truth. The next detail is what flips the whole setup. And now we get to the checklist, the boring metrics that decide the next 2 weeks more than any hot take. 1, watch the curve. Does prompt tightness stay elevated relative to deferred months, or does the curve normalize? 2, watch the cost of immediacy. Are there signs the market is paying up to borrow metal or secure it quickly? 3. Watch deliverability chatter. Delivery windows can amplify stress when participants want to avoid being short the front. 4. Watch flows. Are silver products seeing steady inflows, or is money rotating away? 5. Watch positioning. Does speculative exposure look crowded, and do you see signs of forced de-risking? 6. Watch the macro leash. Silver can act like a high beta metal to moves in real rates and the dollar. If the macro backdrop shifts sharply, it can temporarily overwhelm the micro tightness. 7. Watch cross-market tells. Gold-silver ratios, mining equities behavior, and risk sentiment can signal whether the move is broad-based or localized. None of these alone is the answer. Together, they're a proof stack. Mechanism, structure, flow, physical symptoms, and macro context. That's how you build trust with yourself, not just with an audience. And that's where the real pressure starts. Now, let's talk about you for a second. Not in a personal story way, but in a survival way. Because the market will try to emotionally manipulate you. And if you don't name the trick, you will fall for it. The trick is simple. Volatility hijacks your time horizon. On an up day, you feel like you missed it and you want to chase. On a down day, you feel like you were wrong and you want to bail. The market uses those impulses to force you to buy high and sell low. It's not malicious intent. It's the natural result of a crowd reacting to the same price shocks. And silver is a master at this because it has a history of sudden drops that look like the end, followed by recoveries that make you feel foolish, followed by rallies that make you chase again. So here is your psychology shield. Decide ahead of time what is noise and what is signal. Noise is intraday chaos. Noise is a scary red candle that happens in thin liquidity. Noise is a pullback that doesn't break structure and doesn't relieve the tightness signals. Signal is the curve normalizing fast, the stress measures cooling, the market losing key structural levels, and failing to reclaim them, flows reversing, and positioning unwinding in a way that shows demand is not absorbing supply. In other words, signal is what changes behavior, not what changes mood. If you treat mood as signal, you will get played. And if you treat behavior as signal, you give yourself a chance. That's not a guarantee. It's risk management. And finance credibility lives in risk management. So let yes put a clean bow on it. Price can whip around violently, even if the thesis is correct. That's normal. In a leveraged, tight, reflexive market, it's expected. Your job isn't to predict every tick. Your job is to understand the mechanism, know what would invalidate it, and watch the right metrics as the calendar pressure plays out. And that's where the real pressure starts. So what comes next, near term, in the next week or two? Expect the market to test resolve. Expect fake outs around big levels. Expect sharp moves that feel personal and aren't. If we get a controlled pullback, watch for a retest of prior breakout areas and how the market behaves there. Does it stabilize? Does it snap back quickly after dips? Do spreads stay firm? If yes, that suggests the underlying tightness hasn't gone away and the move may be building a base for continuation. If we get continuation squeeze behavior, watch whether price can push and hold above major psychological thresholds into daily closes, because closes matter for risk books and for how dealers hedge. Also watch whether volatility expands as price rises. Sometimes that SSI in the market is stress testing liquidity and forcing hedging demand. In both cases, the thesis gets weaker if you see the opposite stack. Tightness signals fade, curve normalizes, and price loses key structure and can't reclaim it. That's your invalidation direction. Not someone said a thing on TV. Not a headline sounded scary. Structure and mechanics. That's the discipline. And if you want a simple identity anchor that doesn't feel like begging, here it is. This is a community of people who watch the plumbing, not the propaganda. We care about what forces participants to act. We don't outsource our conviction to a talking head or a single chart screenshot. We stack proof. We respect risk. We stay humble about timing. And we keep our eyes on the metric everyone else ignores until it's too late. Because in metals, the loudest truth is often whispered by the spread.